All right, let's welcome in Manish Gunwani, who's with us. He's a market master of the day, head of equity at Bandhan Asset Management Company. Manish, good morning. Great to have you with us here. Thank you for joining us. You know, the one viewpoint is that since late October last year, the market here, you look at MSCI India, for example, it's underperformed MSCI World by about 20%, dollar terms. So one view is that, you know, you're going to come to a point where some of this underperformance is going to give us a bit of a fillip, a bit of a spring when market starts to move higher. But you need some triggers, right, for that to happen. What are those going to be, according to you, Manish, as you look ahead?
So if I think about globally, I guess the biggest trigger can, of course, be a renewed weakness in dollar. The dollar's been consolidating post the 10% fall we saw over the last 4-5 months. And I guess part of the reasons emerging markets are doing well is the dollar looks weak, while it's not fallen recently, but it does seem to have its challenges fundamentally. On the domestic side, I think last 12 months have seen a slowdown in the economy versus expectations. And I think what can probably turn this around, hopefully, is falling interest rates, tax cuts playing through, maybe pay commission in a few quarters. So we're quite hopeful that the slowdown that we've seen over the last 12 months will get reversed in a sense over the next 2-3 quarters. So I think once you start seeing some traction in nominal GDP, I think India has seen a fairly decent fall in nominal GDP coming down to single digits. I think it's important to get it back to
Oops. I think we lost the line there.
Monetary side, we've seen similar, right? So on the monetary side, we've seen significant stimulus. So we are hopeful that once we see the nominal GDP come back, the outlook on earnings will improve, and we should then see the market resume its uptrend.
India has greatly underperformed the MSCI emerging markets, right, in the last 1 year. Now you're saying that things will improve from here on. What would you bet on? What would be the extent of the improvement? You know, for instance, we were just, reading out a call from Mahesh Nandurkar from Jefferies, and he believes that we will see a bounce, again, for the same reasons that you articulated, but the bounce may not sustain for long due to weak value versus growth equation and equity supply concerns. Now, in the last 1 year, Manish, we've already seen no return for the Indian equity markets.
So I think we should not be focused just on last 2-3 quarters. If you see on a 3-5 year basis, Indian markets have healthily outperformed emerging markets. And once that extent of outperformance happens, there'll be phases where mean reversion happens. So today, obviously, China, Korea, Taiwan, they probably got very cheap at the end of last calendar year. And this year, they will outperform, I guess, just by mean reversion. I think India remains a bit of an insulated story in the sense that, look, foreign investors don't play India to play US consumer or something like that, right? Or US tech, for example. We are a steadily growing, primarily domestic economy. To be fair, we have, as I said, undershot our expected growth over the last 12 to 15 months. I do hope that given the monetary stimulus, and I would think that even fiscal stimulus should start picking up. I think the kind of CPI number we saw yesterday, for example, just shows how much space we have in terms of the macro stability has gone to an extent where I think it's given you a lot of space to stimulate the economy. And I hope we see some strong policy action as a mix of fiscal and monetary, because we definitely, I think, should be, as a country, aiming for double-digit nominal GDP growth. And given that our current account is in a brilliant shape, inflation is in brilliant shape, there's not excess leverage in banking or household sector. I think there is a lot of space to stimulate this economy and get growth back.
Hi, Manish. Good to see you. Where do you generate alpha, though, in this sort of market? In the past, you've spoken about a couple of sectors. I recall towards the end of last calendar year, you were talking about metals, oil and gas as well. Those could be themes that actually you could make better returns. Do you stick to that, or do you think that things have changed? In the metal space itself, if China is going to recover, since there are regulators that are peppering the economy, maybe it could be better times. What's your gut on it?
Yeah, I think metals worth a risk reward rate. See, metal is not a buy and hold sector, but given the expectation we have at least of medium term dollar being weak and China probably bottoming out, and the fact that it just bottom up when you see the cost of extracting and producing these metals versus the current market price, a lot of these industrial metals are definitely cheap. So I think metals is a good risk reward sector. I think consumption at the mass level, um, while it may not be a very structural buy and hold story, but uh, given this phase of last 3-4 years where a lot of consumption stocks have been flattish, I think, as I mentioned last time, there are a lot of brand companies which are available at 1 to 3 time kind of sales. Typically in India, those are very good entry points for consumption stories. And while when you play a cycle, nothing is clear when it will play out. So you can't be 100% sure of a strong consumption cycle coming through. But I think the risk reward is good. I think as I said, the valuations are cheap, expectations are low. So I think with a view of 12 to 18 months, because pay commission may come by that time, um, I think these consumption stocks which are cheap, I think that is a good theme. Structurally, I think the theme remains technology, the internet platforms. Those I think are good buy and hold stories, uh, or any company which can produce medium to high end products and services and export to the world, because there is a shortage of trained manpower globally. So whether it's engineering, pharma, if you can find a company which has got good R&D, has products with more, and which can go global with those products and services, I think that those are two structural themes, I think, which we continue to believe in.
What about cement, Manish? In Q1, we saw good improvement in the realization across in the industry. Do you see competition being rational, and from here on, the EBITDA per ton improving or sustaining? And how is cement looking for you? Looking to you.
Personally, I'm not very hot in cement. I see cement as a trading sector because the penetration in India is very high. Uh, while it is consolidating a bit, it is not a sector with very secular pricing power to my mind. So you have to buy when things are down and you sell when things are good. Today, I think a lot of market participants are very bullish on cement. Valuations are high. Stocks have done well. So not a sector I would be very hot on at this point of time.
Okay, all right, Manish, very quickly, what about defense? It's got a longer runway and there's going to be plenty of focus both in India and globally, but valuations became too expensive. Some of them have corrected. What's your view?
Yeah, to be honest, we've not played this theme very aggressively. The macro has been always attractive in the sense that not only in India, but globally also, particularly in Europe, you're seeing defense budgets shoot up. If you see defense stocks globally have done well. But the point, what concerns us is just it's a one client sector. And the kind of margins we are seeing defense companies make, they are a bit surprising because they've gone up a lot. And of course, the P multiples, even on those higher margins, are very high. So it's not a sector I would be massively bullish on, to be honest.
Look at Aarti Pharma. I don't know if you've highlighted this, right? It's a large cut, 8.5% cut. So just pull the stock up, 784 on very large volumes, by the way, coming through. Coromandel is another one which is around about 4% or so. So that's a large cut, 4% loss there. And by the way, these are all within the top 5 volume-led losers list. Vari started slow. It started actually almost flat, but Vari is now number 2 volume-led gainer, 3% lower on Vari. And of course, we highlighted Suzlon, which is down almost 4.5% at this stage. So stuff is moving on both sides. Although with about 15 minutes of trade behind us, it's clearly advantage gainers over decline. 70 points on the Nifty is what you have. Manish, thank you very much for joining us. Great speaking with you here on CNBC-TV18. Really appreciate it as always.